So this was the main topic I wanted to cover tonight, public versus private. We obviously, as you know, deal in both asset classes, and my focus tonight is on private. So there's this poem that I'm sure all of you know. It's two roads diverge in a wood, and I took the one less traveled. And that has made all the difference. And I have to admit, when I read this quote again, I thought, yeah, that's the Robert Frost poem, The Road Less Traveled. It's actually not called The Road Less Traveled. It's called The Road Not Taken. And that's actually, in this case, more appropriate because private assets, and private equity in particular, are typically the road not taken by investors because they're pretty difficult to access. But they can make all the difference. Another way of looking at it is, this is a quote from Jim Collins in his book, Built to Last. He talks about the tyranny of the or versus the genius of the and. So, when we take a look at it in this framework, think of this statement. I can either have a better return or I can have lower risk. In his way of looking at it, he would say, well, what if that statement was changed? I can have a better return and lower risk. Are the two actually mutually exclusive? And we would like to make the case that we don't think they are. So it's not public or private, it's public and private. This is a graph that's also quite difficult to read, but here are the bottom line numbers related to it. It's the last 20 years, and it's looking at the returns of public versus private markets. So in the last 20 odd years, the S&P total return has been a little over 6% in US dollars. The Russell 3000, which is a smaller mid-cap kind of index, is up a little bit more at 7%, which is what you would expect. But private equity is up 9.1%, which doesn't sound like a great amount, 2.5% more than the S&P 500. But on $1 million, enough to make a difference of $2 million in the portfolio, which is a very significant difference, obviously, over 20 years. So let's look at the factors that have driven private equity. One of them, this is an article from the Wall Street Journal about where have all the public companies gone. In the last 20 years, there's been a 56% decline in the number of publicly listed companies in the US, and that is occurring in many, many countries around the world. In addition to that, American companies, and not just American companies, are buying back their own shares like there's no tomorrow. Now, part of that is related to cheap debt, but the other part is related to the fact that they are making great profits and they don't actually have a place to put those profits back into. So they're buying back their own shares. Now, I'm not trying to be cynical. It is true that executive compensation is driven by options to a large degree, and share prices going up is a benefit if you hold an option. They could obviously not have any share buybacks and just increase the dividends. But that's not the case. The share buybacks drive the share price. And this is the correlation between the S&P 500 and share buybacks, and it's almost 100% over the last 15 years. So share buybacks make a difference to where the market is, which is something to remember when we consider where we are now. But that was $700 billion was bought back in shares in just American stocks last year alone. So where did that money go? Because basically the companies handed it back to the investors. And Canada is really not a lot different. So in the last 10 years alone, we've gone from $5 billion of share buybacks to $75 billion. So when we take a look at it, we say, well, what's driving private equity? Well, part of what's driving private equity is public equity. So we take a look at, this is a graph from The Economist magazine, talking about the huge increase in private equity valuations for the last, 20-odd years. And in particular, if you look at the last 15 years, you'll see that it crossed, this is a global assets under management for private equity, $1 trillion in roughly 2005. Now it's almost $7 trillion in private equity. So people are looking at this like it's manic, like, there's a euphoria in the marketplace that may be getting a little overheated. But we want to look at this in the context of the other markets that exist. So $4.5 trillion has been the increase, roughly in the last decade, in money that's allocated to private equity. $5 trillion is what companies on a net basis have been giving back to their shareholders and not allowing them to put it back in the public markets because there's no place to put it. So when we look at this and consider the scale of private equity, $7.5 trillion roughly US, or 6.7 trillion US, this is a graph showing that last year alone, all global equity markets combined increased in 12 months by $17 trillion to roughly $87 trillion last year in December. Took a bit of a haircut last week, mind you. Private markets are 7.5%, even now, of all public markets combined. So when we look at this, and there was other things that were causing some concerns in markets, this is from Morgan Stanley. They're saying, well, you know, since 2009, private equity companies are paying 40% more for earnings than they were in 2009. So it looks like for every dollar that they're buying of earnings, they're having to part with that much more capital. So then things are getting more expensive. But if we compare it to public equities, for roughly the same period of time, PE ratio bottomed in March of 2009 at 14. This is the Cape-Shiller Index related to the S&P 500. And at the end of January, it was 32. So when you buy public stocks as an index, as opposed to, let's say, specific companies that you might want to buy, you are paying 130% more than you were 10 years ago. So while private markets have become more expensive, it is a much slower rate than public markets. And then let's take a look at who's investing in private equity. I mean, Harvard has one of the best run endowment funds in the US, and they are significantly increasing their private equity. But it's not just Harvard. The Economist magazine pointed out that next to Yale Endowment, Canada Pension Plan has the highest allocation to private equity of major institutional investors at 41% of their capital. Something that might surprise you, the Canada Pension Plan now crossing over roughly $400 billion of assets and is well run. They do a good job. 75% of their assets are not in Canadian dollars. They're invested outside the country. So think of that as you think about how you allocate your capital, that they're very comfortable with limiting their exposure to Canada in total to 25%. And in the US, we talked about the fact that US companies are shrinking in size. What's the private marketplace look like there? Well, you know, this is some data that we were able to pick up. There are 6 million private businesses in the US. Obviously, most of them are small. 98% have less than 100 employees. But to flip that around a little bit, 120,000 have more than 100 employees. And only 3% of these companies are publicly traded. So if you want to own a percentage of the other, let's say, 117 or 16,000 companies, you have to do it through a private equity platform.